this chapter, chapter 7, is on depreciation. Mostly. It's actually taking the cost of an asset and allocating it. Now, on the first tab, we have a classified balance sheet. This is kind of where things go on the balance sheet. It's kind of like a grocery store. You go to a grocery store and you want Cheerios, you go to the cereal aisle. Everybody knows that. Doesn't matter what store it is, you go to the cereal. It's kind of the same thing. We just put everything that's similar together. Current assets and current liabilities are things that are a year or less usually. And everything else down here is long-term. And it's a long-term thing we're going to talk about. So these are all long-term down here. And we're going to talk about allocation of costs here. Let me see. I'm going to zoom in, I think. Oops. Land generally not depreciated. It is possible that we deplete land if it's land that we bought for minerals or timber or lumber, oil, things like that, that we actually use up the land. But generally, regular old land, we don't do anything with. We don't depreciate. Buildings and equipment, there's actually 4 ways. We're going to go over 2 of them in this class. We're going to go over these 2 in this class. And intangibles, they're not depreciated. What they call is amortized. Same thing, though. It's basically the straight line method, which we'll talk about in a minute here. Okay. First thing we're going to do is look at what goes into an asset. What goes into the cost of an asset? So capitalization is a process of finding relevant costs of long-term assets. Okay, so when you buy an asset, what goes into it? And most everything that goes into it is anything to get the asset up and running. So anything that's used to get the asset going is put in there. Now, operating the asset is generally not. So equipment, transportation, we'll have the purchase price, shipping, modifications. This is one that's a little bit unusual. Trial runs of the equipment to make sure it's running right. We put in the equipment. Buildings, purchase price, construction price, architect fees, building permits, blah, blah, blah. All those things that are going to making a building. And the land. Purchase price, obviously. Removal of old structures. We're actually going to do something with that right now. But and in general leveling. Oops. Do it here. I did something wrong. Okay, there we go. Payment of tax liens, legal fees, title insurance. So all those things that go into purchasing the land itself, they will go in there. So this is what goes into land that when you're buying land and creating a building. Okay, so let's go over here. Omar Corporation paid $2,000 for a tract of land that had an old gas station on it. A new warehouse was constructed at the cost on the site at the cost of $550,000. Okay, well, what goes into what should the value should be put on the tract of land? Oh, and here's some other things. These are kind of these are this stuff up here. Anyone we did. So we have the purchase price for the land was $200,000. Legal fees associated with the purchase of the land. $22,000. Architect fees are going to go into the warehouse. So is the interest. Demolition of the gas station. That's this. So the two ones that are a little bit unusual for the land is if you have to remove an old structure, that goes into the cost of the land. And general leveling of the land. If it's specific, it goes into the building. But if it's general leveling, it goes into the cost of the land. Okay, and I'm going to move this down a little bit. So let's see the total cost of the land. Oops. And so this is what we put on our books. Okay, we have that. What we put on our books. Hey. And the important thing about this is the land is not going to be depreciated. Okay, the warehouse. We have the construction costs. $550,000. And we're going to have the architect fees and also the interest on the construction. So normally you expense interest, but if it's part of the construction, if it's directly related to the construction, then we capitalize it. So the total cost of the new warehouse will be that. Something here. And the warehouse will be depreciated. So it's important to break up these costs. And one of the reasons why is that some of this, for instance, none of this stuff is depreciated, whereas the stuff down here does. The land isn't going to go away. The land will be there theoretically forever. But buildings don't last forever, become obsolete, and they get torn down, and new ones will get put up. Okay, so this is for buying new assets. This is kind of how you break up the cost to it. Oops. Okay, there's also, what about existing? For existing long-term assets, betterment versus maintenance costs. Okay. Betterment means you're improving it in some way. So if you improve it, you capitalize those costs. Just like we capitalize the lawyer fees and all that kind of stuff, same thing. You just put it right into the cost of it if it's an improvement, if it's a betterment. If it's regular maintenance, we just expense it. So you get a truck, the gasoline, the battery, the brakes, the tires, those things that are just normal maintenance stuff, those just get expensed. It doesn't make it any better of an asset. But if you do and make improvements to it, that's different. If you make improvements to it, that it's actually a better asset than it was, then it's called a betterment. So regular maintenance stuff, oil changes, new brakes, all that kind of stuff, that will just be, it'll just be orange. No, those will be expensed. So oil changes, new tires, new brakes, those are just regular old maintenance things. Okay. Betterment comes in 3 flavors. I'm going to do something here. I like this whole thing. it makes no difference. I don't know why I'm doing that, but anyway. And these are the 3 criteria. Okay. So if it improves the efficiency of the asset, if it improves the capabilities of the asset, or if it lengthens the life. Okay, so here's kind of the things that if you're looking at a truck, these might be some of the things that you would capitalize. You say, okay, these are things that make it better or it lasts longer. So an engine overhaul to increase the truck's life. So now it's not going to last 5 years, it's going to last 10 years or whatever. Upgrade the truck suspension to haul heavier loads. Again, you're improving the truck. It's not the same truck as it was before. Changing the ignition system for greater fuel efficiency. So now the truck is actually more efficient than it was before. It's an improvement on the truck. So these are the things that improve the long-term asset. Oops, what's wrong? Okay, so maintenance is just the normal stuff, and they're just expensed. These are all just expense things. That the assets performance hasn't changed. Okay. Okay, the 2 types of depreciation methods we're going to look at are straight line depreciation and units production. A couple of important things about depreciation. And I'll put it in yellow. Depreciation, part of it comes out of the matching principle. And that is that you want to match the expenses with related revenues. So if you have something that's lasting for 4 years or 5 years or 10 years or whatever it is, you're making revenues not using that asset. And you want to match the expenses with those revenues. It's kind of common sense, but it's also, it also makes it a little bit tricky. All right. Depreciation is the process of allocating the cost of an asset over its life. So it's an allocation. It does not find the market value of the asset. So depreciation is not there to find the market value. It's there to take these costs. I said, okay, we have these costs of this long-term asset that we paid for this truck or whatever it was. And we're going to use it for a number of years, and we have to spread the costs out over those years. So we're not trying to find what the market value is of this thing. We're actually just trying to spread out those costs and say, okay, over the life of this thing, making this so that those expenses of that item are going to be spread out over a number of years. We're going to allocate it. So it's an allocation. I'm going to add one more thing in here. Oops. Yeah. The rules for allocations are they must be systematic and rational. They have to be both. And systematic just means that it's repeatable with the same outcome. And rational just means it makes sense. So allocations must be systematic and rational. So these methods we're using, they must be systematic and rational. And luckily they are. Okay. So we purchased a long haul trailer. Let me zoom in a little bit here. See it. Okay. Purchased a long haul trailer for $300,000 beginning of the year. The expected life of the trailer was 10 years or 70,000 miles. The salvage value estimated to be 20,000. During the first 4 years, like the following amount. Okay, so here's how we start out with this. We take the cost of the asset. And that was 300,000. Now notice the salvage value. This is the salvage value is going to be what it goes down to at the end of its life. Do something here. So the salvage value is 20,000. So notice it's going to go from 300,000 down to 20,000. So it's going to reduce in value by let's subtract that. It's going to decrease in value by 280,000. So this is what they call the depreciable amount. And that's an important number because that's what we're going to use to, we're going to allocate this over the life of this, over 10 years or 700,000 miles. Okay. Now for the straight line method, we use 10 years. So we're going to divide this by 10 years. I'm trying to think what's the best way to do this. Okay, I'm gonna. So divided by 10 years. Equals 28,000 a year. So this will be the depreciation expense per year. Make that yellow. So every year we're going to depreciate $28,000. Okay, well, let's fill this in down here. The equipment. The book's at 320,000. That's not 320,000 or 300,000. I'm sorry. Depreciation expense is the 28. And that. Okay. And that amount is going to be the same every single year. And here's another thing. This is going to be the same amount every single year. Now, things are going to change. So every year we'll have the same depreciation expense. Every single year we'll have the same equipment expense. Now, the accumulated depreciation is actually the interesting one because this is all the depreciation to date. Now, the first year is just going to be 28,000 because that's all the depreciation we have in 1 year. And what we're going to do is take the equipment. Let's think of color for these. So we'll take the equipment minus the accumulated depreciation, and that will equal our book value. So our book value will be 300,000 minus, 28,000. That's first year. Second year, the 28,000 plus 28,000 will be 56,000. Let me insert my extremely helpful little arrows. So is both of these together? It's all the depreciation to date. Let's take 300,000 minus that. The third year, we've already guessed, is all three of them together. Now, since that's 2 years, you can just add the last one on. But let's copy that. And this one would just be, okay, I'm sick of I'm doing too many of them. Let's add that. It's just 3 years plus that one. It's part of my teaching you guys how to be lazy. Very important. And so these are booklet. So this is actually what this will be on the balance sheet. So the equipment will be the first year. After the first year, it'll be on books as 272,000. Next year, 244. Now, if you're wondering why they call this a straight line method, if you're to chart this out, it goes down in value by the same amount every year. So it's called the straight line method because every year it's going to go down by the same 28,000, 28,000, 20,000, 28,000, all the way down until 10 years from now when it'll be completely depreciated and the value will be, it should be the 20,000. If our crystal ball worked correctly, 10 years, $20,000, it should be down to that at the end of 10 years. Now, be careful on the tests because they might give you this information and then they'll say, they can ask you for any of these things. What would be in the equipment account? What would be the depreciation expense in year 3? You know, they can ask any of these. You know, for instance, in year 3, they can ask you what that. You know, they could ask you what the equipment is. They can ask you what the book value is. What's the accumulated depreciation? What's the depreciation expense? So be careful when you read questions that they could ask you, the multiple choice questions, they could ask you for any one of these. So this is like the important number for the straight line method, and that is how do you allocate those costs over the 10 years, and you do it evenly, you know, you get 20,000 per year, and then you come down here and let's say for year 3 they could ask you any one of those, for year 2, or blah blah blah. You get the idea. So be careful what they're asking for, because they can ask you for any one of these. Okay, let's go to units production. Units production is actually fairly similar. We start out exactly the same. F17. So this is all kind of the same as we had on the previous page, but instead of depreciating it over 10 years, we're going to depreciate it over the units of production, or this way it's going to be 700,000 miles. So this trucking company is going to have uses this tractor trailer for 700,000 miles. Now, here's why they're going to do that. Instead of going the straight line method, it's because of this. They're not going to use it the same every year. You know, there's some years they maybe get a lot of business, some years maybe they don't. So for things that are not used the same every year, units production makes more sense. If you use it about the same every year, you know, just go straight line. But if you don't, if you use it, you know, if some years are good, some years are bad, whatever, you're going to, the units production method is a good one to use. And also, remember, this is for matching the revenues and expenses. As you may imagine, those years that you use the truck a lot, you probably get a lot more revenues, right? If you use it twice as much year 2 as you did year 1, you can expect that you're probably getting twice as much revenue, so you're doing twice as many jobs. So you should be depreciating, matching up the depreciation of this thing twice the rate, you know. So it'll adjust for kind of the revenues that are going into it. Okay, so we have to figure out how much it is per mile. So instead of depreciating it by 10 years, we're going to depreciate it by 700,000 miles. And this will give us a depreciation expense per mile. Ah, okay, it's gonna be more than 0. So this is the depreciation expense Okay, so what we're gonna do is, I'm gonna move this thing. Actually, I apologize for putting this in a bad spot. But move it down here. Okay, so it's 40 cents per mile. So here's what we're gonna do. Up here, we're going to multiply these by $0.40. So take 50,000 times 0.4 equals some number. So 50,000 times 40 cents. So this will be the depreciation expense for the first year. And we're going to do that for each of these years. So these will all be the depreciation expenses. The first year will be 20,000. Next year will be 40,000. Notice we used it twice as much. Third year we used it even more, and then it kind of dropped back down a little bit. Okay, so it's going to look like this: 20,000, 40,000, 52,000, and 32,000. I don't think I bolded this one yet, did I? Did not. Hey, look, we can see it now. Okay. So these are the depreciation expenses. Now notice it's very likely that they won't be the same. If they are the same, you should just use the straight line method. But yeah, so we use 300,000 is the cost. Really depreciation. Oh wait, I didn't use that. What did I use last time? Purple. Oops, not that. Purple. Accumulated depreciation. So our book value will be equals 300,000 minus 20,000. Next year, 20,000 plus 40,000. Excuse me. And just say kind of reiterate what we're, this is just all of the all of these together. Yeah, the total to date. And again, for these years that we use the truck more, you know, we would expect that we have a lot higher income. Let me how to get that is. You'd expect that, say, year 3, we would have a lot more revenue from this truck, you know, than say year 1. So it makes sense that we would expense more that year. And we did. We expensed 52,000 in year 3, but only 20,000 was expensed in year 1. This way, by the way, is the way that the IRS does it. The IRS will allow you a certain amount per mile for depreciation. Okay, that is chapter 7. So I will see you for chapter 8 shortly.